Welcome once again to What the Financials, where we explain financial terms so they no longer frustrate you. So today we're going to talk about dividend yield. So what is that? So for example, if you buy a stock for $20 and you receive an annual dividend of $1, that will give you 1 over 20, a 5% dividend yield. So typically you want your dividend yield to be as high as possible, right? Because the higher your yield, the faster you can get back your money. But a lot of times, if a dividend yield is too high, that is usually a red flag. When a yield is too high, it's usually because of a falling stock price. So investors think that something's wrong with the company, they're facing some trouble, and a lot of people are selling the stock. So when share prices come down, your yield will go up. But the thing is that dividend may not be sustainable because the company's in trouble. So they could have issues with their revenue and their profit. And when that happens, they might eventually have to cut the dividend. So what looks like a really high yield right now in a year or two could be just completely gone, and your yield could just be zero. So what is more important besides just yield is to have a look at a company's financial health and its recent performance and whether it can sustain its dividends. The other thing you want to look at is its dividend track record as well, because if it's a history of 10, 20 years of paying a consistent dividend, that's usually a good thing. And you also want to have a look at its dividend payout ratio, because if it's paying too much in dividends from its profits, that's not sustainable. And so that is dividend yield. So yes, you do want a higher dividend yield as possible, but not too high, because that usually indicates there's something wrong with the company. And of course, you want to have a look at other things to make sure that the stock that you're looking at also is able to pay you dividends sustainably.